we could see the stock market top out and potentially fall 10, 15% from here. And gold keeps going up another 10 or 20%. But eventually when the stock market falls a certain amount and people start to get really scared, there's real fear, we actually enter a bear market, then gold usually doesn't stand a chance. There's enough selling and margin calls and fear that even people sell off the good positions like gold. And so gold naturally will sell off temporarily. Very similar to, what happens near the end of a move is you get a very strong parabolic move. You cannot trust a move that goes straight up because usually it comes straight back down. Very similar to what happened just before the last financial crisis. It shot straight up, came straight back down, and then sold off for 65%. So I think we have that potential for it to shoot higher still. And of course, that'll be good for silver miners as well.
Investors are watching precious metals closely as they begin to show signs of strength while equities flirt with exhaustion. Gold has already surged higher, and though it's pausing now, this breather looks more like a setup for another breakout than a sign of weakness. Meanwhile, silver and the mining stocks have been stealing the spotlight, delivering strong returns as money rotates between different corners of the sector. What we're witnessing is a dynamic flow of capital, moving from miners into silver, then back into gold, almost like a cycle of momentum within the metal space. This delicate dance often appears just before broader equity markets begin to roll over, signaling that investors are seeking safety in tangible, hard assets. ChrisVermeulen, founder of the Technical Traders, has built a reputation as a skilled market strategist who combines technical analysis with practical capital allocation strategies. His work often emphasizes risk management, trend following, and identifying high-probability setups across asset classes. With decades of experience navigating both bull and bear cycles, he brings a disciplined lens to analyzing the interplay between equities, gold, and silver. Looking ahead, the potential for gold to extend another 20% higher, while silver pushes toward the $49 to $50 range, cannot be ignored. Yet the caution remains: parabolic moves, while profitable, often reverse sharply. For investors, this is a reminder to balance opportunity with risk. Now, we present the clips from ChrisVermeulen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We actually own both. We were in silver miners. We've closed them out because we've hit our max target that satisfies that strategy. We're still long gold. We actually own both of them because you don't know which one's going to outperform, and they're both kind of the same play. So you can take advantage of both, split your capital, or you can pick one if you want, but miners and gold, you never know which one's going to take off. So I like kind of both. And gold to me has the highest win rate. When there's a trade set up, it wins most of the time. So I like to have a sure bet in there almost. And then the miners are the more speculative play. No, so if we look at gold, all it's done is, we can look at the 30-minute chart over the past week and a half. Gold has had this a very strong move. And after something's had a strong move, it's just taking a pause. I wouldn't say it's weakening. It's just taking a breather because it just had a hell of a run. It's exhausted. Right. There's just some profit taking. And so even when we look at the daily chart, which is very similar, we're just trading sideways, and it's a little tiny bull flag. It's primed and ready to shoot up. Literally, the next trading session, this thing could pop and run. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. And we're seeing it move into like silver miners and gold miners. You can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold. And gold has got this little pause that it's just had. And now gold will probably shoot up. So I think they're going to like piggyback on each other. That flows into miners and then flows into gold and goes back and forth. That's what I think is going to unfold here. Yeah, if we take a look at silver, we haven't traded silver just because gold, our play around silver was the silver miners. And so silver has done the very similar to gold as it's rallied up, and now silver's had a nice bull flag. It's paused. And so silver's breaking out and starting to run. So money's coming, I think, out of miners now and starting to go into silver. And then I think it'll bleed over into gold because silver is much more speculative than gold. So money's going to rotate probably from miners, silver, gold, and then kind of maybe loop around. I mean, these are very nuanced, small moves, but silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver, we're in a sweet scenario right now with silver where I think we could go all the way up and we could see it spike. And I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow off phase and shoot higher. Very similar to, what happens near the end of a move is you get a very strong parabolic move. You cannot trust a move that goes straight up because usually it comes straight back down. Very similar to what happened just before the last financial crisis. It shot straight up, came straight back down, and then sold off for 65%. So I think we have that potential for it to shoot higher still. And of course, that'll be good for silver miners as well. But yeah, right now we're in that sweet spot for precious metals. And you and I have touched on this cycle graph before. If we look at the stock market, this blue cycle here, precious metals really come to life near a major market top. And one of the reasons is people are moving away from the stock market in general, and they're moving into physical assets, something where they won't lose value or won't blow up on them as much. We could see the stock market top out and potentially fall 10, 15% from here, and gold keeps going up another 10 or 20%. But eventually when the stock market falls a certain amount and people start to get really scared, there's real fear, we actually enter a bear market, then gold usually doesn't stand a chance. There's enough selling and margin calls and fear that even people sell off the good positions like gold. And so gold naturally will sell off temporarily, but it's usually short-lived. Gold only gets pulled down during an extreme wave of selling. It could last a few months in the markets, and then it'll find a bottom way before the stock market does. So yeah, gold is not immune to a bear market, but it can rally in this particular situation, 2007, which is a very similar situation as we have right now. When you look at from price charts and what the dollar is doing and what gold's doing in the stock market, the equities market could sell off and top at any point here, and gold just keeps on going another 20+%. So that's why I like gold.
When analyzing markets, it's not enough to look at a single layer of information. Price tells you the trend, but without time and sentiment, you're only seeing part of the picture. By adding multiple time frames, it becomes clearer whether short-term, intermediate, and long-term forces are aligned. Sentiment then shows where the real money is flowing, whether institutions are distributing, accumulating, or rotating into different assets. That three-dimensional view offers a far more accurate gauge of market health. Today, falling rates are sparking renewed interest in bonds and equities. But the longer-term story remains tied to the broader economic cycle. Bonds, while showing signs of life, still sit in what could be a prolonged basing phase. Stocks, meanwhile, are pressing into resistance levels where previous corrections began, even as internal indicators flash weakness. Gold and bonds stand out as relatively safe havens, offering resilience when volatility rises. Let's get back to the interview.
They pretty much all do the same thing. Now, when the US is in a bear market, almost all of them are. Some of them may be skewed. Some of them might not top out for a month or two later, or some of them might bottom out or top out a month or two earlier. But in general, when you go into a big financial reset, typically they're all eventually doing the same thing. So they're kind of a crowded play. If you focus on the US market, that to me is the key. And there's enough liquidity and enough tools and things that you can follow it very closely. Once you get the international equities, you're kind of running around with your eyes, one eye covered. And I like to look at the markets from 3 dimensions, more or less, which is like price, time, and sentiment. So I always follow the price charts to identify the trend and how strong it is. And time, you want to look at multiple time frames. Are multiple time frames, long-term, short-term, or intermediate, all in favor of the trend? And then the sentiment, you want to know what money flowing in and out of various asset classes. Is there big money selling or buying, or is there distribution selling? And so when you can put something in a 3-dimensional view, you get a really good perspective of the health of it. And most people just, even if they use just like technical analysis, they're just using price charts and indicators. And that's just like one layer. You need to add in time, cycles, and multiple time frames. And then you need to also know the sentiment of the market. How are people thinking and feeling? What are they doing with their money, their chips? Are they pushing them over here, over there? More so, are they going risk on assets or risk off assets, and how much? I think it'll help the equities market short term. I think if rates are getting cut, then people are going to want to go somewhere where they can make more money, which means move away from fixed income and take on risk, move to the stock market. Short term, I think it's good for stocks. It's also good for bonds. Falling rates, we should see the bond market take off. And if we were to actually, just look at TLT, which is the long-term treasury bond, and we'll just go back to the daily chart here, you can see bonds in the last week and a half have just popped and really taken off. Everybody's expecting a quarter or a half basis rate cut. And as rates go down, bonds go up. And when you zoom out on the bond market, you can see, we're still very much so, in a bear market. It peaked out in COVID. And ever since then, we've just been seeing, more or less rates go up and bonds have been going down. And finally, the rates may stall out. And that's why I think bonds are flatlining here, trying to find a bottom, a base. And I think it's still early trying to get into bonds right now. I still think you're picking a bottom, and it might not be in yet, or it still could trade sideways for another year or so. So it's kind of still dead money. I'll be looking for bonds to really have a big leg up and for this downward bias and this sideward bias to shift upward. And then I'll be looking at bonds. It's not about, can you buy something at a low, at a bottom? It's like, can you buy something when it's in an uptrend? So when you get into it, it's consistently moving up in your favor versus hoping it's bottomed. And then it doesn't. And then you waste years with no return or suffer drawdowns. So I think if rates start falling, bonds could become a very good opportunity. And it'll also short-term help the stock market. But at some point, rate cuts happen because the economy's weak and the Fed's trying to save businesses and all that. But there'll be too much selling on the stock market, too much fear, too much weakness, that rate cuts will maybe give a short-term pop in the stock market, but it'll fizzle right back out and stocks continue to go down. So rate cuts are just a very short-term, kind of usually a blip on the chart. And how the markets react, will vary depending where you are in the market stages. I don't always know why or what the market's going to do, but I think when there's generally when a major asset classes changes direction or is starting to change direction, it means there's a big shift going on, and people get very confused. People don't know what to do, and there's a lot of rotation. There's a lot of it gives people waves of half the people are saying, oh, I think this is good, I'm going to start buying. It scares people, and big institutions start unloading. It creates a lot of noise in the markets and a lot of instability. So you start to get low probability trends. The markets are choppy. They're kind of dangerous. When a major asset like interest rates are changing direction, it's going to cause a lot of chaos for a while. And you don't really know how it's going to react or why. Everybody's got their own reasons. The reasons why I see things are probably the opposite of what somebody else sees, right? We all see the market through a different lens. So yeah, you just really have to follow price. And sometimes when things aren't in a strong trend, I just steer clear of them. I just won't even touch them. I'll just be like, yeah, wait for it to have a direction and play that actual price when it's driving up or down in a strong direction. At the Magnificent Seven, but if you take a look at, this is a blend of ETFs that I'm showing you here. So this is RSP, which is the S&P 500 equal weighted. So it's not tech heavy. Everything is equal. So you don't get that false kind of all-time highs. It's also the IWM, which is small cap stocks, and IWC, which are micro caps. So this is giving you like large and small and micro cap. And really the markets are kind of up into these nosebleed territories, which every time we've got up here, we've seen a 20+% correction. So the general stock market is testing at a major triple potential top here. And, there's some warning signs. I mean, actually, if we go and take a look at our short-term indicator, this is one of my sentiment charts. More or less, it tells us when the bars are going red, that is telling us you don't really want to be holding stocks. The internals are weak from a three-dimensional view: time, price, time, and sentiment. You don't want to be holding stocks. And you'll notice we've been having red bars here the last little bit. The market internals are starting to break down, even though the stocks are hitting all-time highs. So it's a warning sign. We just need to be aware that things are kind of weakening from that standpoint. And I like looking at the broad market. Majority of stock markets or stocks are testing highs at best. And that could be major resistance and could be soon a reversal. And we go right back down to potentially the lows that we saw back in 22, 23, when most stocks were bouncing along a bottom. And that would be a pretty big reset. I mean, that would be the general portfolio, dropping 27, 30% from where we are right now. And if we go into a big financial reset, we would break that low, and then we see a much deeper correction. Most big financial resets, like full bear markets, have all been over 50%. The one we saw in 2022 was pretty tame. It wasn't really a big bear market. It was really just it did pull back 20+%, which is technically a bear market from a lot of people's perspective, but it wasn't like a reset. Something didn't break. It was just a lot of profit taking. I think the Fed unloading some portfolio, lightening their positions and stuff like that kind of pulled the market down temporarily. Yeah, I mean, I would probably, when I look at that, I'd go back to the S&P 500 because it's kind of where those 50% corrections are. Let's just see where that is. So that is roughly, it's a bloodbath. It brings us back to the 2020 peak, just before COVID. So it'll wipe out the whole huge wipeout bubble where most people are, people are pretty deep in the profits. Those who've bought and held, depending on what you've held. It's interesting because this is the camouflage. Like, look at this chart, Danny. You look at this price. The market from that equal price is up about 100% on average. If we were to look at the ARK-K ETF, which almost everybody got a hold of during COVID, that same time, I mean, you're only up 29%, and you've gone through one hell of a roller coaster where you went up like 150, and then you lost 50% of your portfolio, and then you're back up. So this is this is the roller coaster ride that most people's portfolios are at, and this is, these stocks are nowhere near all-time highs. This is what I mean. Most people's portfolios are nowhere near highs because they hold all this crap, all of these things that were hot, but they never got out when they became not hot. And so now they're just like really trying to recover what they had lost. And that's the problem, is people chase shiny objects and they don't get out because they're working. Why get out of it? And then they don't get out of it when they're down because they're like, well, I'll just wait for it to come back. And then, most traders lose. That's the reality of it. And it's because of those two things. Emotions take over, and they don't want to take a loss, and they don't want to get out of a winner. And that just equals roller coaster ride. And, usually people move to the most volatile stocks because that's what gets their attention. And that's the roller coaster ride most people go through. I still like gold the most, physical gold or through an ETF. I think that has got good upside potential here. I think it still has 10 to 20+% upside. I also think, because I have to hold it for a year, I think bonds like TLT would be a good position as well. So the bonds could come to life and really start a nice move up, and eventually it'd be nice to sell gold. And because when the stock market does roll over, eventually gold will most likely pull back with it. But gold holds its value fairly well. It doesn't drop as much as the stock market. So I would say like gold and bonds would be those plays. If you had a gun to my head and said you have to buy and hold, it's probably the two that I would do.
The pattern of market behavior we're witnessing now reflects the late stages of a long cycle. Liquidity is shifting, sentiment is fractured, and investors are being pulled between short bursts of optimism and the heavier reality of slowing growth. In these conditions, volatility becomes the constant. Major indexes can appear strong on the surface, but when you strip away the headline names, the broader participation looks weaker and less convincing. That divergence often marks a crucial turning point, where investors need to be selective rather than exhaustive in their exposure. What stands out is the importance of resilience. Assets like gold and eventually bonds provide that defensive posture when markets are crowded and choppy. A disciplined approach, focusing on price, time, and sentiment, creates the clarity to navigate through the noise and see the cycle for what it is. The bigger message here is preparation. Markets don't wait for clarity before moving, and wealth often shifts quietly before headlines catch up. Staying informed, keeping perspective, and positioning before the crowd are what protect and grow capital through resets. If you found this analysis helpful, Make sure to hit the like button, subscribe for more content like this, and share your thoughts in the comments below. Your engagement helps us bring more insights to a broader audience.